There's COS FX, GFTC, and others. Now, what we're looking at here are the different price levels where these brokers have buy and sell orders. Now remember, most market makers aren't going to get into an active trading environment where they're simply trading for their personal or corporate account. You can say that most of the time these traders are executing orders for their clients or holding orders in the market. You can see here that there are several orders at the 5807 level. And there are quite few orders down here at 06, 05, only one at 04, and just two at 03. Now remember, we're talking about why is the doji bar important. Well, what this means is, as the market starts to form these different levels, that every time a price level like this formed at 5807, where the market maker is looking to buy, sellers poured into the market and sold at every single one of these levels. Conversely, when the market formed large levels that they wanted to sell at, individuals came in and bought at every level that they were selling. This process is what's going to form the doji bar. So you can see now that the doji bar is very important, especially when we put it together with high volume. Now the last element is going to be a high volume up day followed by an engulfing or piercing pattern day. Now I'll give you a quick review of what I mean by this engulfing or piercing pattern. You can see that the market is traded up off of a low. The next day trades down well into the prior range. Now a true engulfing pattern would actually gap up to some much higher level here, trade down below the prior level, and close there on the day. Now this would form a true bearish engulfing pattern. That's pretty rare in the Forex market. So most times you're going to see the market move down slightly or open even, but then close, as it does here, deep into the prior trading. This is a bearish piercing pattern. Now the reason why it's important when we're looking at high volume is simple supply and demand. If this represented sustained buying, then the market would follow through. And more specifically, if the professional money was buying, then prices would continue to go up. Why is that? Well, prices would continue to go up because the supply or the sellers would be out of the market. You see, the professional money, the reason why the professional money is going to move the market in this fashion is they want to test, is the market selling at higher levels or is it buying at higher levels? Now what they're most interested in is there additional selling above the current level that they are trying to move the market? In other words, if people in the past had bought this particular market, which you can see that the market did make a low here, if individuals are long from this area, so went through this sustained downtrend, and are now posed with the market being right back where they want it, they need to find out if those individuals are going to sell to exit the market. So quite frequently you'll see the market makers move the market up into these areas to test and see, is there supply? Remember, if there's more supply than there is demand, prices will go down. On the other hand, if there's more demand than there is supply, prices have to go up.